Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Thursday afternoon, we have Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq-100. And Brian, it's for you technicians, it has been quite a ride in January, actually since the middle of December. It's not that we're just seeing movement in the Nasdaq-100. We're seeing 1 to 2% moves in the Nasdaq-100, which, the whipsaw action has to keep you on your toes.
Yeah, I mean, it really started that final week in November when we first had, Powell come out and the Omicron virus, but Powell came out as well and was talking a little bit more hawkish commentary. And, while markets had already been pricing in greater expectations for the Fed being more hawkish in 2022, the Fed is now coming around and saying that publicly. And even further commentary, economic data as well, the inflation data seems to be getting worse and worse. Markets are pricing even, greater amounts of rate hikes. Goldman came out, is now looking for 4 hikes in 22, 3 in 23, and 3 in 24. And the market, I think, is pretty close to 4 in 20 and 22 as well. So much more hawkish commentary.
Right. Well, I guess it really all depends. And we spoke with Phil McIntosh, our chief economist, on this yesterday. It's a matter of how quickly that 7% inflation rate can come down. That's really going to influence the policy going forward. So, Brian, if we take a look at your first chart here, what are the levels that you're looking at with the Nasdaq 100 down, about 1.5%?
So in the near term right now, down today is down about 1.8%. So this is the right here Nasdaq 100 daily period time frame, and the low was made late last week, and then we bounced higher from here. But we broke this range that we had been in for the last 2 months. We broke down the bottom of the range, and if we go back and put our moving averages in there, this is the 150-day period moving average, and it's less widely followed than the 50 and the 200. But you can see ever since the lows of March 2020. The biggest pullback was in Q1 of 21, and we pulled right back to that 150. And then again, on the deeper pullbacks, we bottomed just above it. So last week we did break through that 150 on an intraday basis and then came back up. When we look at the same chart, just taking away most of those moving averages and highlight the prior highs and prior lows, those pivots, we could see that, today we're dipping back down below this prior top from August, September time period, which roughly was the support line on the recent sideways activity over the last couple of months in November. So, that's a little concerning. The trend line that we've been focusing on since the middle of last year, where the big pullbacks have been testing, is this right here. We can best see on the weekly period. And you can see the more times pullbacks test a certain level and they hold that level, the more important that trend line becomes, whether it's a rising trend line or a horizontal trend line, or support or resistance level. And we broke that this week. We closed below it last week for the first time, going all the way back to September of last year. So I should say September of 2020. So this is a long-term, let's say 15 to 17 month rising trend line. And we're now breaking down below it. This week, the NDX is higher on the week, but it's peaking right now. It's basically stalled right at that trend line. And we haven't touched this line in over 6 months. So it's been for us a pretty reliable barometer to look at the NDX. We do want to see it get back above and, eventually to new highs. The concern, the big divergence underneath the hood of the market when we look at the broader averages, is really the growth versus value trade. So mainly what's been happening is, this talk of higher rate hikes, the market's pricing this in. Just last week, we're looking here at the move in interest rates. This is the yield curve. The red line is the yield curve at the end of December 21. And this blue line is the yield curve as of last Friday. And we saw a dramatic move higher across the entire curve. If you look down here, this is the net change for each of the maturities on the Treasury curve. And we could see, going out from the 3-year all the way out, they all moved at least 20 basis points. The 10-year moved 25 basis points. That was one of the biggest moves, the third biggest weekly move in 5 years. On a total return basis, I saw technicians saying that the move was the biggest on record for the 30-year bond. So phenomenal move. And that is, and what you had noted about Phil, is, when interest rates move, the pace of the movement can be of utmost importance. And when you see really sharp moves over short periods of time, that a lot of times can, catch people off guard. What that does is higher rates typically can be more disruptive for growth stocks, those longer duration stocks that have expected earnings that are further out in time. Higher rates will typically hurt those types of companies, those stocks more so. And so what we're seeing here is a long-term monthly, or I should say weekly period chart of the growth index, the large cap growth index over value. And you could see that during the beginning of 2018, for the first 8 months, growth outperformed value by 4.5% each month on average. That's pretty dramatic. And then you can see the white line here, that's the ratio, just a straight wall higher. And when it peaked in August 2020, that essentially was the high of growth outperformance. You got marginally above that in November, just a couple of months ago, but wasn't able to hold. And now we're reversing sharply lower. We've dipped back down below that 40-week moving average. That's a key signal that many technicians I know will use to, let's say, overweight or underweight a specific industry versus the S&P. And so at the moment, it's just beginning to dip below it. So, it's not the end all be all. It can bounce and recover back above. We saw that in 2018. We saw that numerous occasions since 2006 when this long-term trend has been going higher. But it's definitely something to keep on the radar. If we look at specifically technology, it's definitely worth noting that this weekly period chart, the ratio of tech over the S&P 500 just reached its 2000 highs. So it could certainly get above that and through that. It hasn't yet broken below its 40-week average, but you can see the momentum has really pulled back quite a bit. It peaked back in May of 2020, just as we were recovering from the COVID lows 2 months after that. And the recent high in the ratio is seeing a much lower high in the RSI, which peaked around 73, 74, whereas in early to mid 2020, it got up to about 84. So that's our bearish divergence right there. Again, price is king. In this case, we're talking about the ratio. So tech wants to see that get back above. Now, tech's had a nice run. It's outperformed the S&P for the last 8 years in a row. The prior record coming into that was 4 years back in, I believe it was the 1990s. And growth is on its own record as well. It's outperformed 5 years in a row, where the prior record was only 3. In the 1990s, growth has only outperformed value 3 straight years in a row, and that was 89 to 1992. So what we're seeing now, this outperformance by growth, this outperformance by tech, has really been quite a streak. It's been a record historic streak going back to the inception of each index. The Russell growth and value indices go back to 1978. This S&P 500 technology index goes back, I think, to the late 80s, about 1989. So you could certainly argue that just on that basis alone, values certainly overdue to beginning to have a year where it outperforms growth. And when we saw that turn take place in 2000, value lasted for 6 straight years where it outperformed growth. Doesn't mean it has to happen again this time. Certainly a different era, but just something to keep on the radar.
All right, Brian, we appreciate the insight. Thanks for the walk through all the charts, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.